Admiral's shares rose even though first-half profit fell 18%. The useful reading is not that earnings have already recovered, but that investors are looking past a weak period in UK motor insurance towards higher premiums earning through in the second half. That interpretation remains provisional. Claims inflation, competition, and customer demand have not yet proved that the recovery is secure. The immediate problem was timing. Admiral reduced average premiums during the softer motor market of 2025, and those lower prices flowed into its first-half results. UK motor turnover fell 5%, while UK motor profit also dropped 18%. Group profit before tax fell to £429.2 million, below the company-compiled consensus of £435 million. The company had already warned at its annual results that the motor market was likely to remain soft for longer than expected, so the profit decline itself was not a surprise. What changed was the forward signal. Admiral increased UK motor rates by a high single-digit percentage in the first half of 2026, after claims inflation had made the earlier pricing inadequate. That creates a delay between the commercial decision and the reported result. Drivers face higher premiums when policies renew, but Admiral does not receive the full earnings benefit immediately. The new rates must first be earned across the insurance book. Management expects them to support stronger group profit in the second half and continue feeding through into 2027. This is why the market could treat a falling profit number as evidence of a possible turn. The motor combined ratio was 78.8%, worse than last year's 76.6%, but better than the 84% consensus cited in the results coverage. Admiral also announced a £45 million share buyback, giving investors a tangible return while the pricing reset works through the accounts. But there is a second reading. The share move was not solely a bet on higher UK motor premiums. Admiral's European business moved from a £600,000 loss to a £17.2 million profit. Customer numbers passed 12 million, and its electric vehicle insurance book grew 27%. Analysts therefore argued that the headline decline showed only part of the business, with household, Europe, and Admiral money moving in a more supportive direction. That broader picture limits the turnaround claim rather than eliminating it. Admiral may be improving its mix and underwriting discipline, but the central UK motor market remains the largest near-term test. Higher prices can repair margins only if customers accept them, and if claims costs do not accelerate faster than premiums. A rate increase that protects profitability but drives customers to rivals would produce a different outcome from the one investors are currently anticipating. For a holder, the reconsideration is that the share price rise does not validate the first-half earnings. It validates a forecast about the next reporting periods. For a watcher, the important question is not simply whether profit rises, but whether UK motor earned premiums and the combined ratio improve together, without a damaging loss of volume. The strongest current judgment is that Admiral is in a pricing-led transition, not a completed recovery. The evidence supports the prospect of stronger earnings in the second half of 2026 and into 2027, but it does not yet establish that demand, competition, and claims costs have normalized. The next meaningful checkpoint is the company's reported second-half profit alongside the UK motor combined ratio. Until then, the material uncertainty is whether higher rates will fully offset the delayed effect of last year's softer pricing.